Hey guys, and welcome back to the Young Investors Podcast. We're almost at the end of the year. We're at episode 59, and of course, joining me as always is Brandon.
Yeah.
How's it going, Brandon?
It's going all right. Yeah, it's true. We are almost at the end of the year now. We're just a few weeks away from Christmas. Only a couple weeks away. That's kind of scary. That kind of just like sunk in just then, how close we're getting to Christmas. And then, Christmas, New Year's, and then the end of the decade. It's pretty crazy. Start of a new decade.
Yeah, it is pretty crazy. And just before we were talking about what we're going to do for our last episode for the year, we're thinking next week is going to be our final episode for the year, and then we're going to be away for a couple of weeks, and then we'll be back in early January.
Yep.
So if you guys have any questions that you want us to answer in that final episode, then go ahead and leave them as a comment on the YouTube version of the podcast. But other than that, today's podcast.
Yeah, you're in video mode.
We're in video mode today. No, in today's podcast, we're going to be talking about value investing traps.
Yeah.
So this was something that we haven't spoken about on the podcast before.
Yeah, true. We haven't spoken about investing traps. I've spoken a little bit about dividend traps on my channel before, which we might touch on as well, maybe at the end. But there's definitely a lot of value traps that can arise that catch out, particularly people that don't really dive deep into the stocks that they buy. So we're kind of going to be talking about what a value trap is and how you can see it coming, and what businesses, I suppose, tend to fall into those value traps, and go from there. And of course, we've got questions to answer at the end, so should be a pretty good podcast overall.
Yeah, for sure. So should we just dive straight into some news? And the first news story that we had today was that the department store chain Harris Scarfe has been placed into voluntary administration.
Yeah.
Oh no.
Yeah. I didn't see this coming. Then again, I don't know anything about the financials of Harris Scarfe, but I guess that's the thing. You can never really tell that these businesses, just from general observations, going to their stores and stuff, you can't really tell until they actually come out and say. Same thing with like Toys R Us. When I heard that Toys R Us was going bankrupt, I was like, my gosh, really? It's like, I've bought heaps of stuff from Toys R Us. And then it's gone.
It's so strange. Yeah, it is. And I mean, it kind of makes sense. I mean, in the past, you think Toys R Us, like that's like the one place that it was a huge brand in terms of toys, but now it's like you can get all of those branded toys online substantially cheaper. And I think the same thing is kind of happening at Harris Scarfe. It's obviously not a toy store.
Yeah.
For those who are not Australian.
You're right. Everything can be bought online. Yeah.
Exactly. And I mean, I know that whenever I went in there, I always laughed because their prices were just absurd.
Yeah.
And they would always they sell a lot of kitchenware and stuff, and they'd have like a pot, and the price tag would say $600 marked down to $80.
Yeah, exactly right.
Righto. Who's paying $600?
I wonder how retailers get away with those sort of tactics, because you see it all the time. I wonder what the actual specific laws are like. I've got no idea, but I think it would be interesting if we actually knew the laws. Like, what can you actually say is the fair cost of something, and what can you say it's marked down to? Are there any laws to that? Can I say that this is worth $2,000 and I've marked it down to $20?
Yeah, I mean, there are certainly some. I don't know what the rules are, but there are certainly some, because I've seen Woolworths and Coles both get in trouble for doing this, marking down products that were never more expensive in the first place. And I guess, I mean, that you would think that would be the minimum benchmark, would be that if you're saying something is reduced, it had to have been at the original price at some point.
Yeah.
But I always just remember Harris Scarfe just always had those ridiculous discounts, like 88% off pretty much everything in store all the time.
Yeah.
And it's like, when is there not a discount? But
it also makes me think about, like, if these stores can do something like an 80% discount, it's like, I wonder how, like, what is the cost to actually produce that thing that they're selling? If you can mark something down from $500 down to $50, I just wish that you could have some sort of scanner that actually tells you how much it actually cost the manufacturer to make the thing that they're selling, because the markups, the amount of profit that they make on these things must just be huge, because obviously if it's marked down to $50, then it's clearly not cost them $50 to make that thing.
Yeah, well, I mean, a fun exercise that I like to do is I go on Alibaba.
Oh,
and,
yeah.
I look at wholesaling, and just you can pretty much find any product you find in retail. You can find the exact unbranded product on Alibaba for a fraction of the price. And it's basically just repackaging like non-branded products that are bulk produced in China with a private label. And I mean, the economics of a physical store that does that just doesn't work anymore when it comes to online retailing.
No, it's just not keeping up, is it?
It just doesn't make any sense.
No.
I mean, I went into Target as another retailer in Australia for those who are overseas. You go in there now and it's just so much floor space and empty room, and it's like air conditioned and there's a ton of lights on, and I'm just like, I'm getting anxious thinking about
how much it's costing.
All the bills.
Yeah.
Exactly.
All the staff. Yeah. Everything. Yeah.
And then you have Amazon, who just has probably a very dark warehouse that's mostly automated with robots.
Exactly. Yeah.
That does the exact same thing and gets you your order in a day. It's, It's crazy. It's crazy. I mean, I was just reading through that article that you posted there, Brandon, about this, and I encourage everyone to sort of look into voluntary administration and bankruptcy and involuntary administration and stuff. It's very fascinating. But there's been a lot of businesses that have sort of suffered the same fate in Australia recently.
I watched their little video on that. This is from news.com.au, by the way, if you're interested. But I found it interesting, their kind of rationale as to why Australian retail has struggled so much. And they kind of boiled it down to a few things, kind of like basic economic things, like there's been less retail spending, stagnating wages for people in Australia. But the thing that I forgot about is that, of course, in the last couple of years, there's been a lot of international brands that have entered the Australian market. It's like big international brands, like cashed up, like ready to go, that have come in and claimed a market share and just put more pressure on Australian retailers. And you can even see like the classic names that have been around for forever in Australia, even Myer and David Jones. They're struggling. If you look into their financials and that sort of thing, they're not coping very well at all. But yeah, I think you're right. It's kind of like it's a combination of factors, but I think it definitely all stems back from the idea that online retail is just the way of the future. Operating a physical store, you're just never going to be able to match the power of online retail. So yeah. Should we move on to this next one?
Yeah, for sure. Yeah. So the next news story that we had came out of the Federal Reserve. Yeah. What happened at the Federal Reserve?
It's really a non-story, this one. They just came out and said that they're going to hold the interest rates steady. They had their 2-day meeting this week and indicated that no action is likely next year amid persistently low inflation. So they kept in the target range of 1.5 to 1.75%. And in its statement explaining the decision, the committee indicated that monetary policy is likely to stay where it is for an unspecified time, though officials will continue to monitor conditions as they develop. So, yeah, I mean, I chucked this one in because I guess it's kind of important just to stay updated, but it's really a non-story in the end because they're not doing anything.
I mean, I guess it is kind of a non-story because of how much action there's been with the Australian Reserve Bank and the Federal Reserve in the United States. It's kind of been a lot of action this year, a lot of moves, a lot of people just talking about it, I guess, and using it as an influence on their investment decisions. And I've just never been interested in this stuff, to be honest. I just like every time we talk about tariffs and about interest rates and economic growth and that sort of stuff, like it's important looking at the macro, but it's just, I don't know, I just find that stuff so boring. Like I would much prefer to just sit down and find a business that I like and just read about that business in depth. I mean, I don't know. Maybe it's because, I've never studied I've never done a degree in finance or economics or anything like that, I just don't find that macro stuff interesting. But if I had to sit down and look at economic growth numbers and
unemployment numbers and wage data and interest rates all day, I think I'd just fall asleep, to be perfectly honest. I mean, it's just so unexciting. I'd much rather read about, some interesting company out of the US that's doing something revolutionary and what their financials are looking like and going into that detail. So, I don't know. But I think you'd be much the same, wouldn't you?
Yeah, no, yeah, I would be. I mean, I like the theory of it and how sort of I just find it fascinating how the mechanics of
how the big picture kind of fits together.
Yeah, the very big picture. But in terms of looking into economic data and thinking about making projections about how an entire economy or a world economy is going to move in the future, that I absolutely have no interest in. And it really doesn't impact our decisions unless you're involved in short-term market decisions. Yeah.
Unless you're a trader trading this stuff, but yeah. Anyway, so that's that. Non-story, Federal Reserve, they've done nothing. Cool story, bro. Anyway, we'll move on to this next news story here. Saudi Aramco, the world's largest initial public offering, has been finalized, and they're now available to the public. The shares surged. Here's the quote for quote on what the news story says. The shares surged past expectations as it debuted on the country's stock exchange on Wednesday morning. Apparently, it's now the largest listed company in the world. It rose 10% in a day, which is apparently a daily limit. Yeah, I don't understand, because I maybe that's just a mechanic of that particular exchange. I don't even know what exchange it is. But apparently all the news articles were saying, yep, they hit their 10% rise daily limit. So I'm like, wait, what? Since when is stock market investing a limited thing?
Yeah.
It's like, you can make 10% tomorrow, Hamish, but that's all you can make. We're going to stop you after you've made your 10%.
I'm pretty sure that the US market, I'm not 100% on this, but I'm pretty sure the US market has a limit when it drops a certain point, the market's close.
That's true.
Just to stop complete free fall and panic. But yeah, I'm pretty sure there's no limit capped on the upside of stocks. I'm not sure though. That's interesting.
I'm not sure what the Saudi Arabia stock market's called, but interesting. They must have some sort of upward limit on it. Anyway, what was interesting is that the current price of Aramco gives it a valuation of $1.88 trillion.
Cop that, Apple.
Yeah, I reckon. Yeah, imagine Tim Cook. Oh, God damn it.
We should have gone into oil.
Yeah. Oh, oil's where it's at, boys. Oh, no. But interesting. Yeah, interesting. To be honest, I don't follow oil companies. I just thought I'd put this in here because it's such a massive company. Because the question that I have, being a bit of a tree hugger, is as a long-term investor, why would you buy into an oil company? Not even as someone that's so take all of the ethical stuff away, take all of the social problems away with climate change and whatever. As a long-term investor, I don't understand why you buy into oil, because I mean it's just a resource that we're going to run out of, and even now you can see that the economy is slowly but surely transitioning more to electricity. Just don't understand. If you're someone that wants to buy and hold for a decade, I mean, it just doesn't make sense to me. Anyway, that's my point of view.
No, I completely agree with you. To play a little bit of devil's advocate, I would say that, I mean, I think most investors, and I think we probably both agree on this, is most investors are not looking over the super long term. They're kind of looking maybe 2 years out, 5 years out.
Especially those big funds, yeah.
Exactly, and I think that you could make the argument, if you're looking in the short term, which I think neither of us think is a good idea, but if you are, then these businesses could generate quite a lot of cash flow in that short term, because I think that, I mean, there's a lot of the world economy runs on oil at the moment, and that's probably not going to change within the next couple of years, but I certainly agree with you. I wouldn't want to own it just because of their long-term prospects, but also just because I think it goes against my ethics.
Yeah, no, that's it. You got to make sure that you stay within your values. That's one of the things that I think we both preach when it comes to our investing strategies, is stay within your values. At the end of the day, when you invest, you're voting with your money as to what businesses you want to be around in the future. So
yeah,
I'd much rather focus on something, I don't know, like a Tesla than something like a big giant oil company. Yeah.
And just full disclosure for everyone, I am actually a shareholder in the company, so
in Saudi Aramco. I'm full disclosure, I am their biggest shareholder.
It goes against my morals. Full disclosure, I own 4% of the company.
Far out. Imagine that somewhere where they just talk up how terrible, like how it's totally against ethics or whatever, and they just give this disclosure that they own shares in it. That's hilarious. Oh my gosh. Anyway, so I think that anything more to add for Aramco?
No, I think that's it.
We'll
keep an eye on it. See if Apple can chase it down.
1.88 trillion, man. That's a lot of cash. Yeah. That's a big valuation.
Yeah, I was looking at their one more thing on this topic. I was looking at some of their stats, and their revenue is 355 billion 2018, net income of 111 billion dollars.
Wow, 111 billion, man.
Yeah.
Excuse me, sir. Can I just have like 0.1 of those just one of those billions? just a tiny little sliver. Can I have some of that? Anyway,
all right, that's it, I think.
Yeah. Shall we move on to middle section?
Let's do it. So today we're going to be talking about value investing traps.
Yeah.
So some of you would probably know what these are. Some of you might not, and we're going to talk about what they are. We're going to talk about we're just going to dive a little bit deeper into it. Some of the more common traps, why it's important to understand what they are, and I guess some of the ways that you can protect yourself and I guess avoid these traps. Because this is probably one of the major mistakes that a beginner investor would make, I'd say.
Yeah, someone that isn't familiar with really researching into an individual business and really understanding it. Yeah, so I guess beginners probably. Yeah.
I mean, it's kind of an interesting one because it's kind of a problem that people who are smart enough to look into value investing would fall for, but they just haven't kind of crossed the barrier into doing thorough analysis, I guess.
Yeah.
But it's kind of limited to people who are already value investors. So in that way, it's interesting. But what is a value trap? So really, you can boil down a value trap into a company as a company that looks cheap, but it's cheap for a reason.
Yeah.
So really, generally, when we're talking about looking cheap, we're talking about looking cheap on when we're looking at basic valuation metrics. So there's a couple of major sort of, I guess, introductory valuation metrics that you will see if you just do a Google search, you do a YouTube search.
Yeah.
And those really are low price to earnings ratio and low price to book.
Yeah.
So
it's kind of like the measures that you'd see on the front page of a Yahoo Finance, like a summary page on Yahoo Finance.
Exactly. And both of them are comparing, one of them's comparing the earnings to the price. So how much are you paying over their last year's earnings or future earnings in some circumstances? And then how much are you paying over the book value, the actual value of the assets minus the liabilities of the company.
Yeah.
And I mean, traditionally, if you have bought, historically speaking, if you have bought a basket of companies that have low price earnings, low price book, they've generally outperformed the market. Value investing overall has kind of outperformed the market.
Yeah.
But within that basket, there's a lot of room for mistake.
Yeah.
And I guess, we'll probably expand further. We will expand further on this in the podcast, but value traps just reveal some pretty substantial flaws in the classic value metrics, low price book, low price earnings, low price sales that people use. And ultimately the reason why is because all of those metrics provide a rear view mirror view of the company. They're looking at past earnings.
Yeah, exactly
compared to the current stock price.
The other thing to consider, you're right. So value trap is basically something that looks real cheap, but there's a reason for it being cheap. And I think if you asked anyone, the most looked at number to have a look at whether this is a value trap would be a low PE. And I just wanted to talk about the PE because, like what you're saying, PE is about looking backwards, but the PE value doesn't actually tell you anything about whether a stock is cheap or expensive, which I find funny because everyone will tell you that a PE value determines whether a stock is cheap or expensive. But remember, it's comparing this current stock price to the earnings of that company. So it really just tells you what investors think about a stock. It doesn't actually tell you much about the value of that business. In fact, it doesn't say anything. It just tells you what investors think, because investors are the ones that will ultimately decide what the stock price of that business is. Okay? So basically what the PE tells you is just what people think the stock price should be in relation to what the earnings of that company are. So what you end up is, if you see a low price to earnings ratio, it just means that the investors don't expect very much out of that company, because they're trading at a very low stock price. They're keeping that stock price low through their investing, even though the earnings are still pretty good. On the flip side, the high PE, investors obviously expect a lot because the earnings aren't that great, but they're paying a very high price for it. So it doesn't actually tell you, the PE ratio doesn't actually tell you about anything to do with the value of the company you're looking at. It's literally just an indicator of what investors think about the stock. And that's, it's interesting. That's why you probably shouldn't really look too deeply into the PE ratio, but it's interesting how people see, it's super common. People see a low PE and they will base an investment decision just on the fact that the PE ratio is very low.
Yeah, that's a really interesting way of putting it as well, because it really is just, I mean, stock prices and stock prices compared to past earnings is just, it's just, I guess, the opinion of what is going to happen in the future. Like, I guess the way that I'm thinking of explaining this is that the earnings of the company that you're looking at in a price to earnings are from the past 12 months, whereas the stock price is what investors think are going to happen in the future. Yeah. And that's where you get that relationship that changes over time. I mean, like you said, low PE, it usually means that, you know, investors aren't expecting much growth out of earnings in the future, maybe even earnings that are going to go down, which is why they're only willing to pay, you know, quite close to the earnings of the company. Yeah. And I guess, I mean, value investors are looking to go against the consensus. That's what we're trying to do, right? We're trying to, when everyone thinks, or when the majority of investors think that a business isn't going to perform very well in the future, we're trying to buy it then, and then be right when most people are wrong. Yeah. And I mean, that really means that if you don't know what you're doing, sometimes you can fall into what's called a value trap, where you buy into a business which you believe has great long-term prospects. The consensus believes that there aren't great long-term prospects, and it turns out that the consensus is right. Yeah. In that there aren't much great long-term prospects for that business.
So if we're looking at a company, run us through, so what might be a bit of an example of how would we see a value trap coming? What might a value trap situation arising? What might that actually look like?
Yeah, so this is one that I see quite a lot. It happens very often. Right. So this kind of happens when we're looking at a company that has sometimes it happens even with businesses that have a huge, strong brand attached to them. So everyone knows this company, and value investing, kind of the introductory value investing is look for great businesses that are going through short-term periods of negativity. So value investors are looking for businesses that have strong brands attached to them, that have some kind of competitive advantage, that might be going through some kind of short-term problem. So generally I see this happen with a company with a strong brand that has a stock price that's maybe fallen 50%, for example, in this example. And let's say that stock now has a price to earnings ratio of 4, which for those who don't know, 4 is really low.
Very low, yeah.
So I think the market's average is about 18 at the moment, I want to say, maybe between 18 and 20. So 4 is very, very low compared to last year's earnings. So what will happen is the value investor will come along and think, okay, this is a company with a strong brand, so they're going to be around in the future, and it's really priced really low, or it's priced cheaply, air quotes, because it has a price to earnings ratio of 4. And then the investor goes out and buys the stock, and they're expecting, well, earnings are going to remain stable, or they're going to go up in the future, and as a result, the stock price is going to go up with them, because the stock has historically had a price to earnings of 10 or 15, so it could double based on that, and if earnings go up, then it should go up as well. Yeah. But none of that sort of plays out as they expect. Instead, the company's earnings drop 50% in the next year.
Yeah.
And then in some circumstances, the stock price also drops 50% with that. So now you still have a company with a PE of 4, but you're down 50% on your investment, and you are kind of scratching your head wondering what the hell happened. I thought this was a cheap company.
Yeah. I think this just relates back why it's so important that, I mean, this is what Warren, Charlie, Peter Lynch, they all say, that the first key step in your investing process is you have to understand the business. I think this just highlights how important it is that you do have to understand what that business is up to, understand their financials, understand where they're at. Because I think that if you did understand the business like quite thoroughly, then you can probably see most value traps coming, or you can tell when a value trap is arising. Because if you do follow the 4-step approach of understanding the business, then checking for a competitive advantage, and then checking for, checking the management team running the business with skill and integrity, looking at your valuation, making sure you're buying with a margin of safety. If you go through all those, really the first one mainly, understanding the business, then you're going to very quickly realize when actually is the problem that is causing the price to go down, which is representing a very low PE ratio, is that problem more of a short-term, company-specific event, industry-specific event, market-wide event that is purely short-term, and therefore having such a low price presents a good long-term opportunity in a great business? Or is it more of the start of a long-term problem? That's what I think is important, is being able to understand the business to an extent where you can understand whether the problems that are happening to that business are short-term or long-term. Because if they're short-term, well, of course, the big fund managers and whatever, 80+% of the market are going to push the price down horribly, but that gives you a great opportunity. If you can understand the business and realize that the business is going to make it out the other side just fine. Whereas if this problem that is causing such a low PE ratio and the stock price falling like crazy, if that's actually going to be a long-term issue that is going to plague the company for 5 or 10 years, then that's the stuff that you want to try and figure out. That's the stuff you want to see coming, so that you don't invest in a company that is going to be pinned down for like a decade because of this problem.
Yeah, and I mean, I guess the core of everything we're talking about here just comes back to looking at a low price earnings or low price book is not enough in terms of the valuation section of our analysis.
Yeah.
When we're doing valuation, the question that we're ultimately asking, and the question that you should be trying to get the answer to, is how much am I going to get out of this business in the future, and therefore what am I willing to pay for it?
Yeah.
And just looking at past earnings is not a good enough indication, because some businesses have very consistent earnings, meaning their earnings in the past are, in most cases, a good indication of what, relatively speaking, they're going to earn in the next year. It's going to be pretty similar. Some businesses' earnings don't fluctuate too much. But there are types of businesses that have earnings and have sales that fluctuate quite substantially. So I thought maybe we could talk about some of those for a little bit. Some of the sort of common companies that often have value traps, that just repeatedly over and over again throughout their lifetimes have that value trap.
One thing that I just wanted to add in here, I think it fits in well here, what you're talking about with making sure that you don't, just look back on what the most recent earnings is that also when we're talking about how your valuation needs to be more detailed and look at what you can get out of the business, it also stands that when you're doing your valuation, you probably don't want to rely on any figures that just relate things back to the stock price, because the stock price doesn't tell you anything about the value of the business. And this is one of the big things that Warren Buffett says it all the time, is that price doesn't equal value. So I think really the only place that share price has in business valuation or stock valuation, whatever you want to call it, is right at the very, very end of the process, where you've figured out what you would like to pay for the business based on what you think the value of the business is, and then you're taking that number and you are comparing it to the stock price to see, is this business, is the value that I've calculated is it higher than the stock price? Is the stock price lower than the business value? Because that's the last step. That's the only time through the business valuation process that you should start looking at the stock price.
That is an excellent point. I'm so glad you brought that up, because I see so many people falling into the trap of thinking, oh, stock has fallen 50%. It's cheap now. Or it's on sale. It's 50% on sale.
Yeah.
And that is completely irrelevant. What the stock price was yesterday really doesn't matter. To just because the stock falls 50% doesn't mean it's cheap. Even if it's a great company, there are many companies that fall 50% and then they fall 50% again. And then they fall 50% again, and they keep halving, and they go down 70, 80%. So
exactly right.
there's no line at which you can say, oh, it's dropped 50%, I can start buying now, or it's dropped 60%. You have to do an absolute calculation of what the earnings are going to be compared to the price.
Yeah, think about it like, say, Amazon right now, a share in Amazon costs $1,748 right? If, just say, for example, I haven't actually done a valuation on this, but say Amazon, it's one share was actually had a value of about $1,000 right? So imagine Amazon value of $1,000 a share, currently sitting at $1,748. If tomorrow Amazon lost maybe $500 off of its stock price, I bet your bottom dollar everything around CNBC would be saying, look at how cheap Amazon is. Amazon, this is a fantastic time to buy, just because the stock price has gone down by $500 or whatever. Now, that might actually be true, because as I said, I haven't done a valuation on Amazon. But I mean, if the value of Amazon was $1,000 and it drops from $1,700 down to $1,200 per share, I mean, you're still buying an overvalued stock, which is exactly what you don't want to do. So, yeah, the whole logic idea of buying a stock or thinking that a stock is going on sale because the share price has dropped a particular amount, that's completely flawed logic, because it still doesn't relate back to what the business value is. You need to understand the business value to understand the context, to give the share price context so that you can decide overvalued versus undervalued. Anyway, sorry. I just wanted to add that in, to finish that section off. Well, we were going to talk about before all of this, you wanted to talk about what kind of companies commonly kind of cause or create value traps. Did you want to run through some of those points?
Yeah, for sure. Yeah, so I was just kind of saying that there's some businesses that are more vulnerable to becoming a value trap.
Right.
Because of the way that their earnings move. And one of the key types of businesses that you'll come across when you get into investing is cyclical businesses. So cyclical businesses are businesses that go through really strong periods and then really weak periods. Kind of like like a cyclical graph.
Yeah.
I don't know
so
how else to describe that.
They follow some sort of business cycle. I guess that's where the cyclical nature of it comes from.
Yeah, and I mean, all businesses go through business cycles, but some businesses are a lot more stable than others. You can think of something like a grocery store, for example, a supermarket.
Yep.
The spending habits of people does change, but it doesn't change as dramatically as, say, for example, a mining business, which might find a great mine for a number of years, be mining it, generating a lot of resources, a lot of earnings, and then in the next year they might not have the same mining opportunities.
Yeah.
And as a result, their earnings go from really high to being negative for 3, 4, 5 years, which happens in many cases with mining companies.
Yeah.
So that kind of company is one that's a little bit more vulnerable, because in 1 year, their earnings might be really high and they might have a low price to earnings ratio, but it might have a low price to earnings ratio because investors know that that mine is about to run out of resources and they have to put a lot of money into finding a new one or something like that. I mean, I don't know the mining business. That's probably...
It makes for a good example. Yeah, I can see that.
Yeah, I thought it would just kind of make a simple example maybe to explain it. But I mean, there's many examples like this. We have video game producers, might be another one that people might understand a little bit better, is that whenever they're coming out with a major title, we were talking about Take-Two Interactive bringing out Red Dead Redemption, which comes out, or GTA, they kind of produce games every 5 years for each
very
sort
infrequently.
of title.
Yeah.
And as a result, when they launch, or just prior to the launch actually, the stock price rockets up, and then throughout that year their earnings rocket, and then the stock price drops because investors know that there's no big title coming out in the next few years, and as a result, there's not going to be as high earnings.
Yeah, and of course, most of the sales in those instances happen like with the game launch. Like as soon as you launch it, that's where you're taking in so much revenue from the sales. And then you're right. If you're, for instance, Take-Two Interactive is a really interesting example. They make really high quality games. Like their games are really good, but they make them infrequently. Well, they're big titles. I think they have the regular updates on those sports based games. Like I think
they do.
The hockey one or is it the basketball one as well? I can't remember.
Yeah.
But you're right. Those big ones like the Red Dead Redemption 2, those really big games, the Grand Theft Auto series, they happen infrequently. So you're right. They're going to get those sales, like a big chunk of money right when they release one of those big games. And then there might be a period of 2 or 3 years where actually they don't have that big title that's coming out that's going to sell them that huge chunk of money.
Yeah, and the last sort of point I just had here was that most of these businesses, I guess one other type of business I should say that is vulnerable to a value trap is just consumer discretionary businesses. So these are businesses that sell, I guess, excess or unnecessary products, meaning that people buy them when they're flush with cash, when they're feeling good about their financial position, but they are the first to cut those kind of products or services when things are tight, when they're losing their jobs and they need to save money, that sort of thing. You can think of things such as holidays, airlines, cars, the auto industry.
Yeah.
A lot of people just hold off on buying a car because they don't really need to buy a new car kind of thing.
Yeah.
And those sort of businesses, again, go through big periods of strong earnings when the economy is doing very well. And then they go through periods where their earnings drop substantially. And I mean, the trend between all of them is just that they have periods where their earnings are high, which could mean that, and then their earnings kind of drop, which means that while their earnings are high, they'll often have a low price earnings, even though they're actually not cheap because the future earnings don't look that good.
Yeah, exactly right. Yeah, so they're kind of the businesses that we would, or the types of businesses that commonly create the value traps. And I think the next thing that we need to talk about is how do we as investors, how do we avoid the traps? And we've got a couple of points here to talk about. And I think the first one, which we've already discussed a lot, is we just need to understand the business. We really need to take the time to go in and make sure we have a proper understanding of the business, because obviously the share price in a value trap, the share price is going down a lot, and usually it's going down for some reason, right? So we can't just trust that the share price going down is making it cheap. We have to take the time to understand the business, go in and actually analyze the reason that it's going down, and have a look at whether it's a short-term problem or a long-term problem. Short-term problem that the company is likely going to be able to fix within a year, then maybe things aren't as bad as what 80+% of the market, the big institutional investors, are thinking, why they're all selling out. But if it is something that's going to plague the business for a long time, 5-10 years, then maybe it is it will become a trap, and we won't see those earnings rebound or grow, and we won't see the share price go up because of it.
Yeah. No, absolutely. And this whole kind of, I guess this whole section and even our whole investing philosophy just comes down to making sure that you understand the business that you're investing in. You can't just use last year's earnings as an indication of whether a stock is cheap, and you just can't extrapolate what has happened in the past into the future. This is what Benjamin Graham talks about a lot in what am I thinking of? Intelligent Investor. Talking about how that's the biggest trap that people fall into, is they just expect what has happened in the past, or what has happened in the recent past, to continue to happen in the future. And I mean, one of the tactics that I use if you're looking at cyclical companies, if you're looking at companies that have earnings that fluctuate quite a lot, I mean, of course, understand the business, but beyond that, having a look at their average earnings over the past 10 years will give you a much better indication of what to expect over the next 10 years, because you can't just look at their highest year and expect that is going to continue if in the past, every 5 years, it's gone from really high to negative to really high again. You need to take the average of that, because if you hold the investment over a 10-year period, you're going to capture the average plus whatever growth they're able to generate over the past 10 years. But really, it just comes down to analyzing businesses more critically, thinking harder than just, well, they earned this much last year, let's expect that they'll do it in the future. Looking at the industry, what does the industry normally do during these kind of conditions? Because everything happens over and over again in patterns. Just everything in the markets just pretty much repeats itself over and over and over again. Everything's cyclical. So look at what's happened in industries in the past, is likely to expect in the future. And that way you can kind of protect yourself a little bit better than just looking for a low price earnings, low price book.
Yeah, I think the last thing to look at, what you've written down here, is that we just got to make sure that we really understand the business's financials too. Because it's super important. Like if you've got some company that has had a share price plummet on it, but it's got really good cash flows and it's got very little debt, then obviously, and maybe it's got heaps of cash in the bank already, then that company is pretty financially stable. Even if maybe it's got very low debt, high cash in the bank, but it's taken some sort of a hit to its cash flow, still positive, but it's taken some sort of a hit, still quite a financially stable company because it doesn't really owe anything to anyone. But if you had another business that, say, was taking on lots and lots of debt and they take some sort of hit, they've got low cash in the bank, they take some sort of hit, and all of a sudden their cash flows become very minimal or even negative or something like that, then obviously that's a business that is at a much higher risk of severe financial impairment.
Yeah, I mean, the worst thing that you could do is overpay for a business that is also financially unstable, because at the very least, if you only invest in businesses that are very financially stable, they have very low debt relative to their cash and their earnings and that sort of thing, even if they go through a tough period and you make a mistake in overpaying for a business, you fall into the value trap. If it's a great business over the long term, then it's at least it's not going to go bankrupt because it's financially stable. If you overpay for a business, you'll have a dramatic drop in the value of your investment in the short term, and then the long term is very uncertain because it could very well go bankrupt. But I guess that's kind of the core bedrock of our investing is don't lose money. Don't invest in companies that have at least even a likely chance of going bankrupt. Just pick companies that have low debt, and if they go through short-term tough periods, then they'll be able to weather it out.
Exactly right. Yeah, exactly right. That's a pretty good summary of what we're trying to do. Now, I'm conscious of the time. I want to make sure that we still get through our questions for Q&A. Yes. I did put a little bit here. There's another kind of trap that people can fall into, which is actually not a value trap. Well, it's kind of a value trap in a sense. It's a dividend trap. I think I'll just brush through this very quickly. The only thing I really wanted to say with a dividend trap is that's basically just a company that looks like a promising investment based on a dividend yield perspective. So what that means, in the same way that a value trap might mean that the price looks very low compared to the earnings, a dividend trap is where the price looks very low compared to what the previous 12 months of dividends were, and that makes the dividend yield, the current dividend yield, seem very, very high. So that traps people into buying these businesses just because, wow, this dividend yield is amazing. But I don't understand why people fall for dividend traps so often, because the obvious thing is that companies don't have to pay a dividend. And if they've been paying a dividend, they can cut it or they can stop paying it. So for a business that's come into some sort of financial trouble and they've had their share price pushed down a lot, and maybe it is because there's some problem really affecting the financials of the business, one of the first things they're likely going to do to dig themselves out of that financial hole is to cut the dividend. And a lot of people, what this means is that they've invested in this dividend trap because the dividend yield looks amazing. And then the company says, actually, now that you've invested in it, because our share price was so low, we actually need to cut our dividend to make sure that we stay, we can weather out this storm. And all of a sudden, the dividend yield falls back down to exactly back where it was before, because the share price has dropped down, but also now the dividend you're getting has dropped as well. And in which case, you're just stuck with a paper loss, basically. Yeah.
That's the thing with dividends, is that if a company announces a dividend, not only do you receive more cash directly paid to you, but the stock price usually goes up with that. So it's kind of a double win, but it's also a double loss if a company cuts a dividend. You lose your cash flow stream, and also the stock price goes down. So yeah, it's interesting. But I guess that kind of rounds out our major section for today, talking about value traps. I hope you guys got some value out of that. And in the final section, we're going to go through some Q&A questions. Should I pose the first one to you, Brandon?
Yeah, sure, go for it.
So the first one we had here was, when looking to invest in a market tracking ETF, does it matter to go for the top 200 versus the top 300?
I guess it would depend on what market you're looking at, but probably not, especially if you're looking in Australia. This is probably an Australian question because two of the common indices is the ASX 200 and the ASX 300. So interestingly, the difference in market capitalization, the difference in Australian market capitalization between the top 200 companies versus the top 300 companies is 3%. So if you've got the ASX 200, if you've got the ASX 200, that covers 85% of the Australian market capitalization. Then by adding the next biggest 100 companies, you only add another 3% market cap, up to 88%. Which is interesting because it means that the 1,900, 2,000 remaining companies that are left over after you take into account the biggest 300, they only account for 12% of the whole of Australia's market cap, which I find pretty interesting. But it just shows you how much weight there is in the biggest companies in the country, and Australia is no exception. So yeah, really interesting. If you take the top 200 versus the top 300, there's only a 3% difference in that market capitalization. So overall, I mean, you could argue that does matter, but I think for most people, I would argue that it doesn't matter.
Yeah, it's really interesting. I did not know that.
Yeah. And last question of the day, should I ask you this one?
Yeah, for sure.
I got to read through this one. This looks a little bit bulky. Quick question I have is the weighting that you place on analyst forecasts and recommendations. These are easily found on resources such as Bloomberg or Morningstar. Do you tend to invest based on these recommendations or use them as a secondary opinion after your own? Thanks and keep up the good work.
That is a really, really good question. And I guess sort of just to start off with, I guess, how much weight do I place on analyst forecasts? Not that much really anymore. But what I would say is, and maybe you disagree with me here, Brandon, but I certainly think that when you're starting out, it's a good idea to keep an eye on the analyst consensus. I agree. Because one of the bigger mistakes you can make is thinking that a company can grow at a certain rate when it's much more unlikely, or much more likely that they're going to grow at a slower rate. And looking at analyst consensus can kind of ground you in that way. And at least if you're looking at the analyst consensus, your valuation is going to be in line with the market consensus.
Exactly.
Kind of makes sense, which, I mean, over the long term as a value investor, that's not something you particularly want to align yourself with, but it kind of makes sure that you're in the ballpark. And I would say that over the long term, as you sort of develop a better understanding of investing, you want to come to your own opinion, because the way that you're going to outperform the market is by definition going against the consensus.
You have to understand. This is where circle of competence comes into play. You have to understand something so in depth, like for instance Gally, his understanding of Tesla. He understands Tesla so in depth that he can confidently make predictions about the company into the future that do go against what the analysts say. And in fact, he's been correct in a lot of what he's predicted, because he goes so deep into the understanding of the business. But I think that as a beginner, like for instance, when I made a couple of videos on how to value shares, a lot of the comments that I've said have been something like, hey, I've been looking at this business and using this method. I'm going to use a growth rate of 40% annually, and I'm going to use a PE value of 65. And for us that we've been, investing for a while and have taken the time to understand this, like you look at those numbers and you go, what? Like that's... Man, to expect that a company is going to be able to do that for 10 years, that's like a really big ask. But for a beginner that doesn't have maybe the context or the understanding of like what is high and what is low, what is reasonable to expect, what is not reasonable to expect. I mean, just following through those valuation methods, you might end up with some really funny numbers. And I think that's where your point, I really agree with you, is that if you are just starting out, especially when you're playing around with what growth rates you're growing the business out to the future, just go back and have a look at the analysts' expectations. It's okay to disagree with the analysts, but I tend to find that looking at the analysts just quickly makes you realize whether you're way out of whack or whether you're probably in the right ballpark. So if you're coming up with those huge valuations where you're like, man, why isn't every value investor under the sun buying this company right now? This is ridiculous. It's worth going back, having a look at those analyst expectations of growth, and then being, the analysts are only expecting maybe 15% growth, not 60% growth each year.
Very good summary.
Yeah. All right, should we finish it up there?
Yeah, let's wrap it up. Thanks everyone for joining us today. Today's podcast, I almost said video again.
Yeah.
Jeez, terrible mistake.
We're in that mode.
Thanks everyone for joining us. And as we said at the beginning, if you have any questions or any topics for next week, go ahead and head over to the YouTube version of the podcast at youtube.com/Hamish Hodder and leave us a question there on the latest version of the podcast.
Yep.
Thanks, Brandon, for joining me, as always.
No, that's all right. Yeah, make sure you get those questions in, because we're going to finish out the year's podcasting next week. Then we're going to be away for probably about 3 weeks. We're actually just going to do a bit of a review of the podcast and see if we need to make any changes for next year so that we can come back even bigger and better and bring you guys some really awesome content going into the next decade.
That's scary. Jeez.
2020, here we come. Yeah, but so make sure you send in any questions you would like us to answer for next week's podcast. And we'll talk to you guys then.
See you later, guys.